Hello and welcome back to Market Shares. I'm your host, Tony Blodgett. And, we talk a lot about interest rates on this podcast. Well, because it's a mortgage and real estate podcast. So how could you not talk about interest rates? But, the one thing that I've talked about for quite a while on this podcast is the number one thing that I've felt like the administration could do to help with interest rates, which, Trump has been saying, like, we have this task force on this commitment to, help housing and first-time home buyers and all these things. They talked about the builders and getting the builders to, do things to help the average consumer buy more homes and all these things. But the one thing that they could do is they could lower loan level price adjustments, right? I mean, we've talked about this on this podcast. It's great if the Fed lowers rates, but honestly, we've seen the Fed lower rates a couple times now, and we haven't really seen mortgage rates improve. Jerome Powell doesn't do us any favors with his commentary post the decision. The last one was he still seemed pretty hawkish and would not really let out of the bag that any further rate, easing was in the cards. I still think that it is, but he's playing it close to the vest, and the market doesn't like that. What FHFA could do is they could lower the LLPAs, and I think we finally have at least some talk about this happening, but it's coming from a source I didn't expect. And it's not quite as robust as maybe what we were hoping, but there's a chance. You're saying there's a chance. We have some hope here. And it came, by the way, of our good friend, Barry Habib. And we've had Dan Habib, his son, on our podcast multiple times. He's a frequent guest here, giving us market commentary. But Barry's been giving commentary and support to the mortgage industry since I've been in the mortgage industry, since the 90s. And Barry is now on the board. I don't want to get this wrong. I'm probably going to get it wrong. But I think that he's on the board for FHFA. And one of the things that he was able to bring up, which I've heard him talk about in the past too, is the egregious LLPAs that FHFA have in place right now. And honestly, you guys, most of this came after the financial crash, the mortgage meltdown, if you will, in 2007, 2008. Most of this has transpired since then, but in addition to the G fees, the guarantee fees that Fannie and Freddie impose, in addition to that, we have LLPAs. Now, we've always had LLPAs, but they've gotten pretty egregious over time. And I'm going to give you some examples. If you're in the mortgage industry, you probably won't be surprised by these numbers, but if you haven't looked or done the math, it might be shocking to you. But if you're not in this every day looking at mortgage interest rates, if you're a real estate agent or a consumer, these numbers may shock you. But let's go back to what Bill Pulte said the other day. This all dropped when he made a post on X, which seems to be where everything, all the breaking news is on X. And Bill Pulte seems to frequent that with very cryptic, drops of information in X. But what he said, and I think I got this verbatim here, but he said, Barry Habib is great and is presenting options to fix LLPAs and bring some relief to homeowners and homebuyers in President Trump's America. The days of Biden are gone. Okay, well, we're going to talk about that for a second. I hate it when we take something that's housing related and make it political, but that seems to be the day that we're in. I'm just reading the tweet or the X. Do we call them tweets still? The tweet verbatim, and that's what he said. So, but it was very cool to hear, Bill Pulte, the head of the FHFA, talking about his new relationship now that Barry's involved, and the fact that we finally got someone in the government talking about LLPAs. Now, here's the part that you may not know is reading through this article further, it really where it's at right now is Bill Pulte did a second tweet, and he said, look, in addition to the feedback from Barry, we're looking for addition from everybody. Our goal is just to do no harm. And I'm like, well, just do something with the LLPAs. I promise you, no one will see this as harm, especially Fannie and Freddie financially. And I'm going to talk about that when we get towards the end of this to give you a glimpse at how Fannie and Freddie are doing financially, and it will blow your mind. But anyway, the scope of this is, at least right now, feeling like it's going to be a little limited. And what I mean by that is we have LLPAs for all sorts of things. Matter of fact, I have the grid here in front of me on my laptop, and I'm just going to give you some examples because, again, if you're in the mortgage industry, you know these numbers. You may not know them, right? You may just go into a pricing engine and price out your scenario and you see, oh my gosh, that rate's a lot higher. But maybe you haven't given much thought to what the math is behind that number. So let's just talk through these really quick, okay? So we'll start with purchases, okay? So if you're purchasing a home, the first thing we look at is there is a grid of loan level price adjustments that's purely based on your FICO score and the loan to value. So how much you're putting down and what is your credit score. So the lowest it could be is 0. So you might have 0 loan level price adjustment, and you fall into that category if you're putting at least 25% down or more, and you have a 780 or more, 780 or higher FICO score. So perfect credit, 25% down, no LLPA. The only, if you're putting 40% down, pretty much regardless of your credit score, there's no LLPA if you're putting 40% down. Until you get under a 640 FICO score. Now, keep in mind, these are Fannie Mae and Freddie Mac conforming loans, totally different math when we look at FHA, VA, or USDA, but which are not the majority of the market in most areas. The majority of loans are going conventional, conforming loans, Fannie, Freddie. So those are really the only scenarios. So over 780 with 25% down, or pretty much any credit score with 40% down. Otherwise, you're paying some sort of adjustment to the interest rate because of your down payment and credit score. Let's look at the average home buyer. So let's just say that someone is at a 700 to 719 credit score and they're putting 10% down. That's going to be 1 3/8 additional cost. So just think like 1 3/8 discount points more that you have to pay because you're putting 10% down with a 719, under 720 FICO score. But even someone with a 739 FICO score putting 10% down is paying 7/8 of a point, so almost 1% more. So on a $500,000 house, 1 point is an extra $5,000. So they're just under that. Even with 10% down and a 739 FICO. So that's the light version. Now, where it gets a little bit crazy is when we look at investment homes, second homes, and cash out refinances. So I'm going to go into those numbers, and that's really the area that Barry has said needs the most attention. And clearly you're going to see that when I show you these numbers or talk to you about these numbers. And I'm sure my team can put a graphic up on the screen to show you these LLPAs from Fannie Mae. You can also just go to just Google Fannie Mae LLPA matrix, and you'll see this. It's pretty self-explanatory. So in addition to your loan to value and your credit score, you also then have these additional attributes, right? Things like, is it an adjustable rate mortgage? Is it a condo? Is it an investment property, a second home, a manufactured home? Is it a high balance loan? That's a loan between the conforming limit and jumbo, kind of that space in between. A high balance loan, for instance, is a 100 basis point adjustment. It's a full point. These are typically $900,000 loans. So we're talking about an $9,000 adjustment in the price, even as low as 20% down on a high balance. Now, if it's a high balance adjustable rate mortgage, it's 2.5%. Now, if you know anything about adjustable rate mortgages, you know that there's very little premium pricing available on those. And so, there's very little premium pricing available on any loans, meaning you can't really just raise the interest rate to absorb this cost. But on ARMs, it's even worse. And so you're having to pay 2.5 points more for an adjustable rate loan if it's high balance. It just basically makes that product, you just wouldn't do that product. Let's just put it that way. And that's the point here I'm trying to make, is some of this stuff is just so egregious. But the things I wanted to get to, the areas that I think we can see some relief: second homes, investment properties, and cash out. Let's talk about those for a second. So on a second home, if you're putting 10% down, it's 4.125 points. That's in addition to the credit score adjuster. So if you're at a 720 credit score and you're putting 10% down, you got another 100 basis points. So now we have 5 1/8 points for a 10% down, 719 credit score borrower. And that's for both a second home and for an investment property. It doesn't matter. So you're trying to buy a rental property. People talk about, oh, buy rental properties, build your portfolio, right? You want to build wealth through real estate. You guys, if you have a 719 credit score and you're putting 10% down on a second home, you can't do 10% down on a non-owner, but I'll tell you what it is with 20% down. But 10% down, second home, you want to buy that beach house or whatever for your family, a little cabin or something, you're paying 5 3/8 points. If that's a $500,000 home or loan that you're obtaining, that's almost $27,000 in loan level price adjustments. And again, there's not really the ability to just raise the interest rate and roll that cost in. You could probably roll in some of it, but you would have to raise the rate so high that there's no market for that interest rate. No one on the secondary market wants that rate. So there's just no premium pricing available. Like, this is a real problem. Second homes, to give you an example, before these went into effect, it was like 50 or 75 basis point adjustment for a second home at 10% down. And now it's 4 1/8. It is the exact same as purchasing an investment property. The difference being is that on an investment property, you're utilizing the rent to help you qualify for that purchase, where on a second home, you have to qualify on your own for your current home plus the second home. So if your debt to income ratios work, like, what's the difference? You know what I mean? But yet they are charging 4 1/8. So $27,000 on a $500,000 loan. If you're putting 20% down, let's say that you want to buy some investment properties. You put 20% down, it's 3.375 plus whatever your FICO score adjustment is. So maybe it's another 100 basis points. So you could be at 4.375 points additional to purchase an investment property, 3 3/8 of that being because it's an investment property versus, say, your primary residence. This also brings me to the point of, you see all the lawsuits they're talking about, right? People that have gamed the system, occupancy fraud, right? There's been big headlines about this. The gal on the Federal Reserve that they're claiming, did occupancy fraud. Now, we could argue that might be somewhat politically motivated. I'm not going to get into that, but this is what they're talking about. Choosing to do your home as owner occupied when it's supposed to be a second home, or it's supposed to be an investment property. It's big money. It's $20,000, $30,000 potentially, depending on the size of your loan. So this is real avoidance, and this is what puts it into that kind of fraud category. It's already fraud because you're misrepresenting your intention with the property. But I guess my point is, the motivation to do that is because these are so substantial, these adjustments. So the good news is what Pulte has said, and based on the interview that I think Housing Wire had with Barry about this, is there's not really a plan to overhaul the whole LLPA structure, which I wish that there was, because there's so many things that I could go over in here that are just would blow your mind on how expensive we're making it for people, especially when I tell you how much money Fannie and Freddie are making. But at least we're going to get some relief. At least they're talking about some relief specifically on the non-owner occupied and the second home. I would make the strongest argument for second home, because investment property, like, I get it. This is still government agencies, right? They're still in conservatorship with the government. And I could see where a government-backed loan doesn't really want to help you acquire your real estate portfolio with subsidized interest rates and whatnot. whatever. I guess I could see that. But second homes, I mean, you're qualifying for these. I don't think the risk is the same. The risk has never been the same in the 30 years I've been doing this industry, but yet they're pricing them as if the risk is the same as a rental property. Even though you can't rent it out, you don't have the same risk of someone damaging your property or, all the things that happen with rental properties. All right. So let's talk about cash out refinances, because I think right now there is a huge opportunity to do cash out refinances, right? We've talked about how people have been in their homes for longer than ever. They have more equity than we've ever seen in the United States. And we know that there's more debt out there than ever. And we know people are struggling with their car payments and just keeping up on debt load. So what if we could strategically help them refinance to completely change their overall household debt structure and free up some cash flow? Like, a lot of people could benefit from this. And a lot of people are doing it despite what I'm going to tell you is the loan level price adjustments here, because they're expensive. So as an example, if you want to do a cash out refinance on your home and you're only going to go to 75% loan to value, so you're still leaving 25% of your equity in the home, you're pulling out 75% of the value. And let's say that you have some credit card debt. And because you have credit card debt, even though you haven't made any late payments, but because of your credit utilization, your credit score is a little bit depressed right now. So let's say that you have between a 680 and a 699 credit score. Now, I understand that a lot of people have higher credit scores than that, but it's very difficult to have over a 700 credit score while maintaining maxed out credit cards. It just typically doesn't happen. So this is your average family that's struggling to make ends meet because of all that's going on in the world today with inflation and the job losses that we're seeing and the government shutdown, and the list goes on of the pressures. But they have equity and they've had to lean on credit card debt. And so as a result, they're at a 699 FICO and they're only trying to pull out 75%. They're leaving 25% of the value in the home. The loan level price adjustment for that scenario is 2.875. So on that same $500,000 example, it's $14,375 that they're paying to Fannie Mae as a loan level price adjustment, or they're having to take a significantly higher interest rate to help offset that almost 3 points that they need to cover, when that $14,000 could have gone towards their kids' schooling. It could have gone towards paying off their maxed out credit card debt. It could have gone to home improvements that would bring value to the home, or paying off hospital bills, right? The list goes on of what people could use that for, but it's 2.875, and that's at 75% loan to value. You go higher than that, or the FICO score goes lower, you guys, this only gets worse. So that's the bad news. Oh, and by the way, if you happen to live in a manufactured home, it's another half a point on that cash out refinance, or $2,500 more because you live in a manufactured home instead of a stick-built home, right? It just keeps adding up. So that's the bad news. The good news is it sounds like there's some relief coming around LLPAs, but don't get too excited. When I first heard this, I got really excited, but the scope, at least for now, is limited to second homes, investment properties, and cash out refinances. And that's a good start, right? I'll take that for now. But hopefully this conversation brought some awareness to you about what's really going on. And this is why when let's say you're a real estate agent and you're working with a borrower and they tell you, man, I met with my lender and they quoted me this rate. And you go, man, that rate sounds horrible. But you should go shop around. Well, without knowing how much money they're putting down, exactly what their FICO score is, and maybe even the fact that they're looking at a manufactured home or a condo or any of these other attributes that can add loan level price adjustments, you're making that recommendation that the rate that they're being quoted is too high without knowing the factors that went into that interest rate. And so that's just a reminder to the real estate agents out there, or even if you're just a consumer, and you hear one person's rate significantly different, typically it has something to do with the attributes of their loan, their credit, their down payment, and the combination of those things, they have a significant impact on what the actual interest rate is. So keep that in mind, right? When you're giving advice to your buyers. All right. So I promised you that I would tell you, you may be thinking, well, Tony, Fannie and Freddie, it's a lot of risk for them to do those loans, right? People are pulling cash out, it's risky. They're buying a second home, they're extending themselves, it's risky. Well, and you may think that maybe Fannie and Freddie need that LLPA just to stay in business, right? We can't let Fannie and Freddie go away. So I can't pull 2025 numbers because they're not out yet, but I can pull 2024 numbers, which is less transactions than we did in 2025. So I can only assume 2025 is going to be more than this. But in 2024, poor Fannie Mae reported $17 billion in net income, and their sister company, Freddie Mac, little old Freddie Mac, pulled in $11.9 billion in profit. This is not revenue. This is profit. So $17 billion for Fannie, just under $12 billion for Freddie. That's, around $4.5 billion a quarter for Fannie Mae. So look, guys, they're not struggling financially. This marks the 28th consecutive quarter of profitability for Fannie and Freddie. They have not lost money since the crash. And granted, they did lose money in the crash and they had to get bailed out by the government, which is why the government has them in conservatorship, which is why the government could step in and make some changes to these LLPA grids. And I think that they should. I'm glad that Barry got through to them and we've started the conversation with second homes and investment properties and cash out refinances, especially cash out, right? People need help. Let's give them some help. It's their equity. Help them tap into it and restructure their debt in a way that saves their family money. But let's take a look at all this. I did an episode about how many first-time homebuyers there are and how low that number is. Part of it's because of this. They don't have perfect credit. These are government-backed programs. For gosh sakes, let's give people some help, some relief. So I want to shout out to Barry for his efforts in moving this needle. I honestly never thought that it would happen. I've sat here for all this time hearing Trump talk about housing and interest rates and all the things he wants to do, and not one mention of LLPAs until Barry got involved with FHFA. So thank you, Barry and MBS Highway, and all the work that you do. But let's keep pushing on this, you guys. And for those of you, hopefully this was an education. If you're in the real estate space or you're not super familiar with how these things work, hopefully it's an eye-opener, and now you understand what the government could do to make things better. And hopefully you also understand, if you're a real estate agent, what the lender's going through in trying to find the best rate for your customer. It's not always as simple as it sounds, and not all rates are the same because it's based on the unique attributes of each buyer and their situation. So you guys, hope that was helpful and informative information. Give a shout out to Barry when you get a chance. Let's continue to push this this narrative around improving LLPAs. And let's also continue to push the subscribe button for market shares. We're trying to get this channel up to over 1,000 subscribers. That's really going to help us out a lot. So if you watch this content and you enjoy it, do us a favor and subscribe and let people in the industry know about what we're doing. And check back every Friday at 10 a.m. Pacific time because we're dropping a new episode right here. Until then, take care.